The good news, if you're doing these in chronological order, you've got through the pain of FSA at this point and you're into the fun stuff. Really, this reading should be called, or this module should be called, ratio analysis. There's a little bit more around it, but we're going to get through that in about 9 seconds. It's all about having fun with ratios, and I emphasize the phrase there, having fun. It is not calculate ratios. Calculating ratios is the easy bit. Interpreting them, which is what I define as having fun, is where the good stuff is, where you're going to earn your crust. So that said, let's get into it. First, LOS is the outside stuff around and about ratios, describe tools and techniques used in financial analysis, including their uses and limitations. So let's look at the framework. That's really all that's in this LOS, a framework of how to approach a project of financial analysis. 6 steps. Number 1, articulate the purpose and context of the analysis. We're going to keep talking about that word as we go through this module. Context, context, context. Why are we doing this? And against what background? Because if you don't decide that, you could go off in a completely wrong direction and collect irrelevant data. So make sure you know why you're doing it. Collect your data, process it, analyze the data. This is where ratio analysis is going to come in. Develop and communicate conclusions and follow up. A little bit of a link there to the world of ethics, which is always nice. Once you've presented your reports, you must follow up and make sure that everything you've said, you still stand by and is still relevant. But apart from that, I've got very little to say about this framework. It is not the main focus of this reading. It's really to introduce you to the idea of purpose and context are key. And then in the middle here, ratio analysis is going to be our friend. And here it is. What is ratio analysis all about? Why bother? Well, ratios help with comparability. Huge word again in any financial analysis. They can remove size as a factor. We're going to look at common size statements, which I know you've seen before. So that'll be like an old friend as well. They can remove the impact of different currencies. If you start to use common size statements and express things as percentages, as ratios, it doesn't really matter what currency they're in. And obviously, if we look at ratios over time, then it's going to help us identify trends. Ratios highlight relationships, truth, between financial accounts and from one point in time to another. We can do cross-sectional analysis, or we can do trend analysis, and they'll look at relationships between financial accounts. For example, on a very basic example, net profit margin. That will compare the relationship between your net profit and your revenue. You would hope as revenue rises, so does net profit. It'll tell you whether you've lost control of expenses. But beware, all ratios do is pose questions. They are not the answer. They indicate things, but they then require interpretation. In this day and age, you can bring up any one of a number of different websites, different vendors, different providers, who will give you all the ratios you could ever dream of, already calculated for you. That's not what this module is training you to do. Yes, you need to know what's in the ratio and how to calculate it, but you need to know that so that you can properly and usefully interpret them. That's where the fun stuff is, and that's where you will earn good money. If you are good at interpreting, then you will do well. If all you can do is calculate, well, there's a million different programs and bits of software out there that will replace you in an instant. Drawbacks of ratios, they are at the mercy of GAAP, generally accepted accounting policies. Accounting policies distort them. You've seen numerous throughout the modules. Think of LIFO versus FIFO in inventory. Think of your different depreciation methods within PPE. They may need adjusting to common GAAP. We're obviously talking there about IFRS versus US GAAP. So LIFO, FIFO is another good example. Only US would allow LIFO. Capitalizing research and development. Both would write off research. Slight differences on how to treat development. And finally, there is no standard form. So I said earlier, there are hundreds of vendors out there who will give you sets of ratios. Be careful. Make sure you know how they've calculated these ratios, particularly when we get into the realms of profitability ratios. We'll mention it very briefly, and coverage ratios as well. Different people will have different definitions of what constitutes a return to capital, of how we should calculate our interest coverage. So it's up to you, it's up to the vendor how you calculate. There are no rules. This is not like IFRS versus US GAAP saying this is what a ratio is. You can calculate it how you like. And the universe is limitless. We'll mention very briefly in an LOS that there are industry-specific ratios. By just telling you that, I've basically covered the LOS. But be aware, what's a relevant ratio for retail, revenue per square foot, is going to be fairly irrelevant for a bank. Just one more slide before we properly get into it. Just to summarize the value, the limitations, and the sources of data. The value we can use, as we've already said, I think, in the module already. We can evaluate past performance. Yes, we can. And look at the current position. So obviously, performance is going to be more income statement focused. Position more balance sheet. Give insights for predicting the future. We can use both the income statement and the balance sheet to forecast. Evaluate changes over time. Well, yes, we've just said past performance. And compare to peer groups, cross-sectional rather than over time. Limitations. Well, I think we've mentioned accounting policies already, and I've hopefully made it clear that it's all about interpretation, your judgment. However, a couple of other interesting points. Finding comparables for multi-divisional companies. When we talked about comparing to peer groups, cross-sectional analysis, what do you do if your company is in 5, 6, 7, 8, 9, 10, 15 different businesses? If so, calculating a ratio overall, so let's say a net profit margin for all 15 lines, is probably going to be fairly meaningless. You may have some very low margin businesses and some very high. You want to separate them out, which is why you will see, and we talked about in the income statement module a little bit, segmental reporting. Don't calculate the net margin overall. Try and break it down into its business segments, and then each segment you can perhaps compare to a more sensible peer group. Where do you get the data? I mentioned already, you can go online and there's plenty of vendors, plenty of sites that will give it to you. Our focus here obviously is going to be the financial statements, pulling information out of the financial statements to calculate useful ratios. Now, before we define all the different categories of ratios we're going to use, quick revisit of common size statements. Vertical, first of all, which we have seen before. Balance sheet, you express every line as a percentage of total assets. Income statement, a percentage of revenue. That's where, for example, our net margin will come from. And a choice in the cash flow statement, either each line as a percentage of revenue or each inflow as a percentage of total inflows and each outflow as a percentage of total outflows. We saw that in the relevant modules, be it income statement, balance sheet, or cash flow. What we haven't mentioned so far are horizontal common size statements. What happens there? Every line item is expressed as a percentage of the same item from a base year. So you're not comparing one item to another. You're taking, for example, on the balance sheet, inventory. If your base year was 2019, I don't care what number inventory was, it might have been 8.3 million, for example. You set that 8.3 million as your base number and say that is 100. In 2020, you then express it as a percentage of that base number. So if inventory went up by 10%, you'd say in 2020 it's 110 and so on. Obviously, what horizontal common size statements allow you to do is spot a trend in each line item. And when you put them all together, you can see the changing structure of your income statement or your balance sheet. How do we use ratio analysis? We've already said this, I think, at least twice. Cross-sectional, one company versus another, sometimes known as relative analysis, or trend. Over time, what would be useful for trend analysis? Horizontal common size. It also mentions graphs, a visual approach. Yes, as I say there, we can use graphs. I don't have much more value to add to that. I think we all know what a graph is. And regression. You will meet regression in quant, so there's a nice little tie-in the curriculum. Regression obviously allows you to identify relationships or correlations between variables. So you can see over time which factors are driving net income, for example. So Common size, which we've seen before, and a little bit of chat around it. Finally, let's get in to the ratio analysis. Here's the LOS: calculate and interpret activity, liquidity, solvency, and profitability ratios, 4 categories. So we do need to calculate them, but hopefully, if it's a sensible exam, and I've no reason to suspect it won't be, the focus will be on interpret. Don't view this LOS, as I say, as, right, I'm going to sit down now, I'm going to learn 58,000 ratio formulas, and in the exam, calculate 70,000 ratios. Not going to happen. Lots of the questions rather, will give you the ratios and ask you to interpret. And we're going to bring out some of the examples from the module, and you'll see that's mostly what happens. Here are the ratios. Interpret them for me, not just raw calculation. Let's start off by defining what those categories are, what they mean. First up, activity. That measures your efficiency of operations. So how efficiently do you use your assets to generate revenue or to generate profits? As a very high level overview, you could have 2 companies that both generated $70 million in turnover, $70 million of revenue. One of them might have used $70 million worth of assets, and one of them might have used $1 worth of assets. Extreme example, but you see the point. The second example there, getting the same exact 70 million revenue from $1 of assets is a lot more efficient. That said, you've got to be careful because maybe one is very capital intensive, one isn't. Maybe one required more staff, which aren't reflected as assets on the balance sheet, but might still be very expensive. We then have liquidity and solvency. Liquidity, are we able to meet our short-term obligations? So you're going to be looking there at the current section of the balance sheet, current assets, current liabilities. Solvency, can you meet your long-term obligations? This is all about your mix of debt and equity. That's where you're going to see your leverage ratios and your coverage. Profitability, for most people, the ones you're more familiar with, the ability to generate profits from its resources. Things like net margin, as I keep saying, I think we're going to be fairly familiar with. But all net margin is telling you is how do you turn your revenue into profit. That doesn't really tell you anything about how you used your resources. So as well as net margins, gross margins, operating margins, all from the income statement, you'll see in profitability ratios will start to combine balance sheet and income statement numbers to get a better view. Return on equity, for example. How much did we generate using our equity? ROA, using our assets, and so on. They are categories, as I mentioned earlier on, context is king. You can't just look at a ratio in isolation and make decisions and interpretations. They are a social animal. If I just said to you, okay, company A's margin in 2022 was 12%. Interpret that for me. Literally impossible. You could say it's 12%, it's positive, which is good, but beyond that, you've got nowhere to go. So you have to know the context. Compare it to prior periods. So is it trending upwards or downwards to the industry norm? Is that 12% anywhere near the average for the industry? To your competitors, just breaking down the industry? And to their goals, what they said. If they were aiming for 90%, it's terrible. If they were aiming for 3%, it's great. So you just don't know. Set your expectations, view it in the context of economic conditions. Think back to 2008, the great financial crisis. If you took your data from 2008 for the financial sector and looked at ratios in isolation, you'd say everybody's terrible. Obviously, you need the context, the macroeconomic background. So I think that's enough setup. I think we've introduced it fully. Let's get into the categories of ratios. First one then, in some detail, activity. What does it measure? We said efficiency. It's asset utilization and how efficiently we are using those assets to run our operations. It's a measure of operational performance. We can break it down into the use of working capital and longer term assets, and both. Let's start with working capital, because there are 6 ratios here that we can group together and learn as a group and kind of make it easier to keep in our head. And they are our turnover and days. So 2 types, turnover and days, for inventory, receivables, and payables. 3 big aspects of your working capital. To calculate the turnover ratio for each, because there's a turnover and a days for each of the 3, that's where the 6 come from. For the turnover ratios, we look at the relevant income statement figure divided by the average relevant balance sheet figure. So this is worth pointing out. I said earlier on, there are no rules. It's the Wild West. Calculate what you like for ratios. But in the CFA curriculum and in practice, to be fair, preference is if we have an income statement balance and a balance sheet balance, then it's preferred to use the most recent income statement figure. So let's say that's 423 and the average balance sheet. So 22 and 23 halved if you're just looking at 2 years. The reason for that, the income statement is a flow statement. It shows you everything you've earned over the year. On the bottom, the balance sheet shows you a point in time. So imagine you took on a huge new asset, you purchased a new asset, issued some new equity right at the end of the year. Well, that hasn't had time to generate revenue, generate flows over the year. So by taking the average of the start and the end of the year, you get a better idea of how much on average you had as a resource to generate that flow, to generate whatever it is you're looking at, revenue, cost of sales, profits, whatever. So that's the one rule you would look at. So turnover, you take the relevant income statement on the top, divide it by the average balance sheet. Days, you simply take the number of days in the period you're looking at. If it's a year, 365, that's the most common because we're using usually sets of financial statements for a year, for a whole period. And you divide it by the turnover ratio you've just calculated. So you can calculate turnover and turn it into days. If you didn't want to do that, given we are dividing by the turnover ratio, you could also think of this as the average balance sheet figure over the income statement. So you're just inverting this times 365. Either way, entirely up to you. So let's look at the 3. Inventory first of all. We said it's income statement over average balance sheet. The relevant figure from the income statement is where inventory appears, which is in cost of goods sold. So cost of goods sold from the most recent income statement on the top, divided by, obviously, average inventory on the bottom. That is the relevant balance sheet figure. To turn that into a days figure, and we call it days of inventory on hand, we'll take the number of days on the top and divide it by that inventory turnover. What are these ratios doing? Because it might not be immediately apparent how to interpret these. On the top, cost of goods sold for inventory turnover. On the bottom, average inventory. It's telling you how many times did your inventory go through the income statement as cost of goods sold. Hence the name turnover. How many times did you turn over your inventory during the period? That is directly related to the days of inventory on hand. If you take the number of days in the period and divide by that turnover, it's telling you on average, how long does inventory stay sat in your warehouse? Let's say we calculated an inventory turnover of 10 times. On average, you sell your entire inventory 10 times during the year. Your days of inventory on hand will be 365 over 10. 36.5. If you're turning it over 10 times during the year, on average, it sits in your warehouse for 36.5 days. Now we're measuring efficiency here. We'll be more efficient if we have higher turnover ratios. If that goes up to 10, 11, 12, 15, 20, you're turning your inventory over quicker. As the turnover ratio goes up, hopefully, obviously, your days of inventory on hand comes down. Double your turnover ratio, you're going to halve your inventory on hand, days of inventory on hand. And we'll talk about why that will happen or might happen on the next page. Receivables turnover, income statement over average balance sheet. Relevant figure for receivables is revenue on the top from the income statements, and obviously average receivables on the bottom. This is telling you, on average, how many times do you collect your receivables during the year? Flip it over, 365 divided by that. How long does it take to collect from your customers? If your receivables turnover this time is 10, it means on average it takes 36.5 days to collect cash from your customers. And finally, payables turnover. Relevant figure from the income statement. Well, that is interesting. We're looking at payables here, what you owe your suppliers. So you're thinking about purchases. A lot of analysts, a lot of vendors, a lot of sites will break this down and say, well, I'm going to try and find purchases on the income statement. Often to you as the analyst using the financial statements, a breakdown of purchases is not available, so you have to use cost of goods sold. Divided by average payables tells you how many times do you pay off your suppliers during the year. Take the inverse, 365 divided by that, tells you on average how long it takes to pay your suppliers. So that's our first look really at, well, some doubt about how I personally would choose to calculate it and how others would choose to calculate it, but that's rife throughout the world of ratios. We could say the same thing about receivables turnover, that I'm not happy with this. Really, in here, I should only be thinking about credit sales. If there were any sales made for cash, then that's going to distort the ratio. But again, that information is unlikely to be available to you. For payables turnover, would be great to get purchases and only those purchases that were made on credit. Again, probably not available to you. So we'll use the information that we have. That's our first set of ratios. Let's do the good stuff, the interpretation. Inventory turnover. We said number of times you sell your inventory during the year. If you can get that above the industry average, if you're high compared to your industry, that suggests, and I use that word advisedly, suggests that we are being efficient in our inventory management. We would have a high turnover and therefore, if this is high, a low days of inventory on hand. Why is that good? If we're being efficient, we don't have to have as much inventory in the warehouse as our competitors, or rather it doesn't stay there as long, which means we save cash. The longer your inventory sits in the warehouse, the more it costs you to store it and insure it and so on. But is that the reason? This is why we need to be able to calculate ratios and know what's in there. Cost of goods sold on the top, inventory on the bottom. If I decrease my inventory levels, this ratio is going to go up and make me think I'm being efficient. But am I? Do I simply have inadequate inventory levels? In which case, I'm at risk of stockouts, not being able to meet demand. And if that's the case, I don't get revenue. In isolation, as we said, ratios, not that useful. So let's compare it. In this case, check revenue growth. If I have high inventory turnover, low days of inventory on hand, matched with strong revenue growth, then great. Yep, that does suggest I'm being efficient. If I don't, that begs the question why. Why is this ratio low and not turning into revenue? If I keep turning my inventory over, it might be that I have inadequate inventory levels. It might be that I've just had to throw some inventory away. A big sudden drop in inventory might suggest obsolescence. So be careful. Receivables turnover. If that is high versus your industry, positive spin, I'm being efficient in my debt collection. I will have low days of sales outstanding, collecting from my customers very quickly. That's great news. Or is it? Are my credit terms too stringent? Am I being too strict? If I am, I may well be missing out on revenue. Again, check the revenue growth. A good way of tempting customers to buy from you is obviously to give them more generous terms, allow them longer to pay you. So check revenue growth and a receivables aging schedule. See how old your debt is. If your debt starts to drift into older categories, that could be a worry. And finally, for this screen, payables turnover. How quickly do you pay your suppliers? If that's high, you're paying off your suppliers very quickly. Why? Do you have worse credit terms than your competitors? And if that's the case, why is that? That might kind of worry me that I was a bit of a credit risk. You want to take advantage of credit terms offered. You want to pay your suppliers as late as possible without getting fined, obviously, or paying interest charges, but pay them late. Effectively, then your suppliers are helping you finance your business. But the argument may be, well, I'm paying early because they give me an early payment discount. If they give me an extra 2% off for paying within 10 days, I'm going to take advantage of it. Let's see why. Compare to liquidity. Once again, in isolation, not overly useful. Let's compare it to liquidity. If we're paying off very quickly, paying off our suppliers very quickly, and we have huge cash balances spare, then that would suggest to me maybe we are just taking advantage of early payment discounts. On the other hand, if payables days are extending, if this is going up and up and up and up, and I don't have any cash, it might simply be because I cannot pay. That is bad news. It pays to compare a whole range of data. And to finish off activity ratios, we have 3 more. Again, I've just kept the definition here for context so we know what we're doing. We've looked at working capital, individually receivables, inventory, payables. We can look at a ratio called working capital turnover, which is how much revenue we generate given the average level of working capital we've got. Once again, this is an income statement figure over balance sheet, hence most recent income statement and average balance sheet. This is a different ratio than the previous 3 turnovers we looked at. The word turnover in those first 3 meant how quickly do we turn over that balance? How quickly do we turn over inventory, receivables, and payables? On this screen, turnover simply means revenue. This is how much revenue do you generate with your asset base? Dollars of revenue per dollar of. Obviously in this one, working capital. Here, fixed capital. Could be fixed, could be total down here. So total it in this last one. So it's how much you generate given a dollar. Higher is greater efficiency. As I mentioned earlier on, context. The industry you're in is important. If I'm a big manufacturer, clearly I'm going to have a lot of property, plant, and equipment. If I'm in the service industry, I am not. If you have skilled staff are not on the balance sheet. They're not part of assets. So just be careful. Am I expected to have inventory? Am I a manufacturer that has huge inventory balances? Am I a service company that does not? So that's important. Once again, fixed asset, total asset turnover. Higher means greater efficiency. If it's low, maybe inefficient. But set your industry expectations. If it's a capital intensive business, you would not expect your total asset turnover to be as high as industries where it's service based, skills based. It might be a new business, not yet at full capacity. Might be that we just bought new assets. I mentioned it earlier on. Maybe you bought a huge set of new assets right near the year end. They haven't had a chance to kick in yet. So all these ratios are going to do, once again, is beg questions. That's the key. Now then, that's probably enough of me talking for a while. So let's start to see some of these examples from the module. First one is a straight computation. And part of the reason I brought this out really is to show you, look how boring this is. Look how frustrating it is, because all you're doing is making a calculation. An analyst would like to evaluate Lenovo Group's efficiency in collecting its trade accounts receivable. How would we do that? Well, we calculate either inventory turnover. No, we wouldn't. We calculate receivables turnover or days of sale outstanding. Analyst gathers the following information. We have trade receivables at 17 and 18. So there's your 2 balance sheet figures. We can take those and calculate an average, which we've done here. And we take revenue for the most recent year. There's my income statement, which we're going to use in here. And they use it to calculate days of sales outstanding. They go via our turnover. We turn it over 9.6 times. Income statement divided by average balance sheet. 365 over that because this is for a year. Gives you 38 days on average. It took Lenovo 38 days to collect receivables. And there ends the story. As I say, frustrating. Good, bad, indifferent, I've no idea. Hence, you'll see most of the examples in this reading are a lot better than that. Can't rule out a straight calculation question, might happen, but expect to be asked to do something with this number. Compare it to something, use it somewhere. Here we go. An analyst has computed the average DSO for Lenovo for the years ended 31st of March 2018 and 2017. This is more fun. Now I have context. Whenever you're presented with data, first thing I do is make sure I'm absolutely 100% on which way time is going, because sometimes they switch it around. Time is going here from right to left, and then I draw an arrow in to show the trend, 37.6 to 38. Days of sales outstanding has increased without any other information. My basic assumption there is people are paying, rather taking longer to pay, which is not a great thing. So let's compare it to revenue, see what's happening. Revenue increased from 43 billion to 45. Okay. Analysts would like to better understand the change in DSO. Makes sense. Whether the increase is indicative of issues with the customer's credit quality. Now that would be a worry given that it's increasing. So the analyst collects accounts receivable aging information. And this is one document or one piece of analysis we alluded to earlier on. Finds it from the annual reports, computes the percentage of accounts receivable by days outstanding. How do we feel about this? Total sales down here, total receivables for each year. So you can see 97, 97, 97, well, whatever, not overly excited about that. Let's break it down. My eyes will obviously be immediately drawn to the oldest amounts outstanding, over 90 days in this case. There you go. Time is going this way, 15, 16, 17. Back in 2015, percentages, 8.99% over 90 days, 8.34, okay, that's good, 10.74. That's not so good. So the oldest have increased. There's now over 10, almost 11% as opposed to only 9. 0 to 30 was 71.99, is now only 59. That has plunged. So this ratio begged the question what was going on. This answers it. It is an issue for me. Accounts receivable are getting older on average. What's the concern? Well, the concern is the older they get, the less likely they are to be collected. Every business should be putting aside a provision for amounts that will not be collected. And we have information on that. What Lenovo is calling provision for impairment back in 2015, 2.35%. In 2017, I mean, yes, it went up there, but in 2017, it is only 2.14%. Debt is getting older. The provision for impairment, the uncollectible debt provision, has got smaller. That is questionable. I don't know the answer, but that's something on an analyst call that I would want them to explain to me. Hopefully you can see that's a more fun example and question than the previous one that said just calculate it. Let's do another, where we start to combine ratios. ZZZ company is a hypothetical manufacturing company. As part of an analysis of management's operating efficiency, an analyst collects the following activity ratios from a data provider. What do we have? Once again, time is going from right to left. Time is going this way. Let's look at the trends. DOH, days of inventory on hand. So this is tracking inventory. DSO, days of sales outstanding. What's happened to DOH? 48 down to 40. Kind of not much plateau, but down to 35.68. So certainly a trend downwards. Without context, your basic assumption, an increase in efficiency in managing our inventory. Days of sales outstanding, 76, down to 51, up again, down to 45. That's crashing down as well. Collecting cash a lot quicker, managing our inventory a lot better. Total asset turnover, remember that is dollar of revenue per dollar of assets. It's gone from 0.22 to 0.23 to 0.28 to 0.36. That's trending upwards. All three of those are going in the direction you'd like. Inventory management looks more efficient. Sales collection looks more efficient. Total asset turnover, generating more revenue per dollar of assets. Everything's great. Let's read the chat for context. These ratios indicate the company's improved on all three measures. Agreed. Managing inventory more efficiently, receivables faster, higher revenue to total assets. The overall trend appears good. Yay. But thus far, and this is what we said up front, all we know is what happened. We must ask why. We can't just walk away from this and say everything is good. Because understanding good changes as well as bad ones facilitates judgment about future performance. To answer the question, the analyst here went on and examined company financial reports, as well as external information about the industry and economy. Context. In examining the financial statements, the analyst notes that in the fourth quarter of 2018, the company experienced an inventory correction. That doesn't sound great. And that the company recorded an allowance for the decline in market value and obsolescence of inventory of about 15% of year-end inventory value, compared to 6% the year before. What does that impact? Well, obviously it's going to factor into your days of inventory on hand. Our average level of inventory has just plunged. Remember the turnover ratio, cost of goods sold over average inventory. Days of inventory on hand, 365 over your turnover ratio. If inventory is plunging, that's going to increase your turnover ratio and decrease your days of inventory on hand. When did it happen? Fourth quarter of 2018. So it's affecting this. So now I'm allocating some of that drop, not to efficiency, but to obsolescence of inventory. As it says back to the chat, this reduction in the value of inventory accounts for a large portion of the decline in DOH. Reading on, management claims this obsolescence is a short-term issue. Okay. Is it? Let's find out. Analysts can watch DOH in future interim periods to confirm this assertion. Absolutely. Let's find out. All else being equal, we'd expect DOH to return to a level closer to 40. Yeah, we've now established this was a one-off event. 48 down to 40, I'm still mystified about. But I don't expect it to stay at 35. Total asset turnover, what did they find out about that? Positive stuff. Company's revenues increased more than 35%. Total assets increased by only about 6%. Denominator up by 6, numerator up by 35. That's why your total asset turnover is increasing. Attributes the increased revenues to growth in the industry. Good news. And the company's improved market share. More good news. Management was able to achieve growth in revenues with a comparatively modest increase in assets. Great news. Leading to an improvement in total asset turnover. That is all good. Note further that part of the reason for the increase in asset turnover is lower DOH and DSO. How does that work? Well, DOH, DSO both include assets. Days of sales outstanding, receivables. Days of inventory on hand, inventory. So if they're coming down, you have on average lower levels of receivables, lower levels of inventory, lower asset base. That is going to help total asset turnover. We are done with activity ratios. Next up, liquidity. We said liquidity was your ability to meet short-term obligations. Level of liquidity you need differs by industry. Recording this in 2023, kind of first half of 2023, looking at the banking industry, going through some troubles. Due to liquidity issues, once your customers start to withdraw your cash, you can be in trouble. You have to have reserves available to meet those withdrawals. Now, is it adequate? Depends on analysis of historical funding needs and access to capital. If you have readily available access to capital, you can easily take on lines of credit. Well, I'm not too concerned about your current liquidity. If, on the other hand, you struggle to raise capital, you've dipped into the well too often recently, and there are no simple lines of credit available to you, then your current level of liquidity becomes absolutely crucial. 3 ratios to look at, all fairly straightforward. The current ratio could not be easier to remember. It's all about current stuff, current assets on the top, current liabilities on the bottom. There might be lots of, prepayments and accruals and things like that floating around in these two, but essentially what you're looking at here is inventory, receivables, cash. Because we're including inventory and receivables, the assumption here is that they are liquid. We are looking at our ability to meet short-term obligations. Can these assets pay off these liabilities? Well, yes, they can if they're liquid. Inventory might be a bag of sand that a builder needs to turn into cement that they then need to use to build a house, which they then need to sell and collect the cash for before it can be used to pay off liabilities. People don't like being paid in sand. So you might want a slightly tighter measure. The quick ratio is cash, short-term marketable investments, and receivables. What we're missing there is inventory. It is a tighter measure. Let's take out inventory because that might not be liquid and get the quick ratio. Old school term for it, which you may see kicking around, is the acid test. And finally, the cash ratio, a kind of crisis measure. If we take out inventory, yep, we've got a tighter measure with the quick, but let's take out receivables as well. They've got literally what cash and short-term marketable investments do we have that we can immediately turn into cash or is cash to pay off our current liabilities. But even in a crisis, you've got to be careful. Can you get full value if the market is in crisis? But you can see going from top to bottom, these are getting more and more strict in their measure. On a very basic level, the higher these are, the more liquid you are. The lower, well, you might be concerned, but remember, it's not necessarily fatal if you have a low current ratio. And a lot of people say, it's got to be above 1. No, not necessarily. You might be relying on the cash flows you generate. If you are a mature, successful company, you might keep generating CFO. You're using it to reinvest, but if you need it, you can use it to pay off your current liabilities. You may have access to outside financing. But be aware, the lower these ratios are, the more reliant you will be on these sources. As an analyst, you need to go and check those sources. 2 more liquidities. First of all, the defensive interval ratio. Pretty difficult to calculate from the financial statements alone. On the top, it looks an awful lot like rather the quick ratio, cash, short-term marketable investments and receivables, so no inventory. On the bottom, daily cash expenditure. How long can a company pay its daily cash expenditures with existing liquid assets? The higher it is, the more defensive you are. Obviously, the more defensive you are, the lower risk you have, but it comes at a cost. If you want this to be higher, it's because you're holding more cash on your balance sheet. That costs you money. Holding cash costs you money. You've raised it from somewhere, and it's going to cost you more to raise it than you can earn holding it on your balance sheet. So the higher it is, the more defensive you are, but obviously it lowers your risk. And finally, for liquidity, the cash conversion cycle, sometimes known as the net operating cycle. Both terms are given in the curriculum. Good news, it's not a new ratio. It's just a combination of ones we have already met, namely days of inventory on hand, days of sales outstanding, and days of payables. What's it doing? In a nutshell, it is measuring the gap between the date you have to pay for the goods you buy, your raw materials, if you will, and the date on which you collect cash from your customers. That is a gap. Now go back to just a very simple example. Imagine week 1 of a company's operations when it first starts. It has no cash, but it has to pay for goods before it can sell a product and collect cash from its customers. So you're in a hole between those two dates. That is going to cost you money. It requires financing. The gap between paying out and receiving from your customers needs financing. The bigger that gap is, hence here, the longer your cash conversion cycle, the more it will cost you to finance it. How do we calculate it? Well, let's go from the date we buy our goods. So here, we purchase them, to the date we finish making our product, using those goods, and sell it. That is days of inventory on hand, how long that inventory from buying it to selling it is sat in your warehouse. But unless you're selling for cash, most people are not, most people are selling on credit, you don't get the cash yet. You've got to wait for your days of sales outstanding, the number of days until your customer pays you. So adding together your days of inventory on hand, let's say on average it sits in your warehouse for 38 days, and it takes customers 30 days to pay you. That's 68 days between buying and getting cash from your customers. The only good news is you probably don't pay for your goods on the day that you bought them. You get credit terms from your supplier, so you get a little break there until you have to pay out. So you can subtract from this 68 the number of days payables. How long did it take me to pay my suppliers? Let's say 35 days. That would give me a cash conversion cycle of 33. 33 days that I have to finance that gap. Gain on its own, fairly useless. I want to know if it's increasing or decreasing. I also need context. If I'm looking here, let's say at a grocery store, one of the huge chain grocery stores, well, they sell for cash. They basically hold their suppliers over a barrel and say, if you want our contract as a farmer to supply us, you've got to give us great terms. So most of those huge grocery store chains will have a negative cash conversion cycle. You'll be paying for the goods before they've paid the farmer. Now, does that make it the best business in the world? Not necessarily, because margins are low. So if you think of this as a racetrack, every time you go through this cycle and turn your goods into finished products and collect the cash, you take out profit. Grocery stores are going to race around that track extremely quickly, but take out a tiny margin every time. As opposed to a high-end jewelry store, let's say, which may have phenomenally expensive, high-margin items sat in their showroom for weeks, months. They may crawl round this cycle at an excruciatingly slow pace, but take a huge margin out every time they get round. Different business models, different ways to make a profit. Let's play with some examples. Here we have real life. An analyst evaluating the liquidity of Apple calculates days of receivables, inventory and accounts payable, and the cash conversion cycle. Days of sales outstanding. Let's just get the way time is going again. We're going this way again. So days of sales outstanding, not much there, pretty constant. Days of inventory on hand, 6. Okay, it drifted up to 9, but that's still absolutely minimal. Number of days of payables, compared to the other two, huge. An example of what I was just talking about. Apple gets your money for the product before they've paid their suppliers. They have a negative cash conversion cycle. Here's the chat. Minimal DOH, maintains lean inventories. How do they do that? Outsource manufacturing. In isolation, the increase in days payable, 86 up to 112, might suggest an inability to pay suppliers. We said that earlier. It might be a concern. If that's drifting out, can you pay them? Well, let's check the balance sheet. Company had 70 billion of cash and short-term investments. I would suggest if they were able to pay their suppliers sooner, or rather if they needed to, they would be able to. So that's clearly not a concern. This might be the fact that they have great credit terms. People want Apple's accounts, so they're taking advantage of that. It makes sense. So instead of requiring additional capital, they have excess cash to invest for over 50 days, 60, 76, during the 3-year period. Nice business if you can get it. Interestingly, a lot of these big, huge chains where people want their accounts and will grant them a generous terms have negative cycles. Starbucks, for example, is a good example, slightly different example in terms of how they achieve it, but Starbucks gets their working capital funded by you. No, you load up cash onto your loyalty cards. Great, you're paying for goods before they've even sold them to you. And those loyalty cards, those balances basically fund their working capital. So all sorts of different ways to try and get around this funding gap. One more example just to prove the importance of context and bounds. It says bounds here, meaning within the bounds of possibility. Just be sensible. So we're looking here at another company, National Data Computer. Let's ignore the chat for a minute because it gives everything away. Let's just focus on the numbers. I just want to focus down here. We're going from left to right. Days of sales outstanding, 28 down to 21, down to 18, kind of average down to 17. So a big drop in DSO. In isolation, my initial positive spin, they are collecting cash from customers quicker. That's great. DOH, days of inventory in hand, 45 down to 37. Okay. This word now starts to leap out. Initially, I'm like, oh, great. They're managing their inventory better. It's now gone down to 1.82, 0.28, a none. That is beyond the bounds of kind of reasonable improvement. Something dicey is going on here. So I'm going to glance back to the income statement. DSO, what was going on? 3.2 sales, 262. Sales are disappearing. That's bad. So I didn't even need a ratio for that. Like, this is just bad. Inventories, the reason DOH is coming down is because inventories have disappeared. They don't have any. That's not good. Accounts payable, days payables, 66. Oh, bad. I mean, it came down there. Maybe they were finally forced to sell off assets and pay it or something. I don't know, but all of this looks bad. Apple, we said, oh, great. They've got a negative cash conversion cycle. It looks great. Here, that negative cash conversion cycle seems to be because sales are disappearing. They can't afford to buy inventories and they have no cash to pay their accounts payable. This just looks awful. So, previous example, cash conversion cycle, key metric, less positive, better it is. That's what we said for Apple. However, large negative number here probably is not a good performance. What's going on? Here we are. This was in their next 10K in January 2011. So things roll on. Our inability to meet our financial obligations, impending loss of critical distribution agreement granting us a right to distribute certain products, our secured lenders acting upon an event of default sold certain of our assets. This was obviously bad. Negative numbers are great. It looked good for Apple in the context of the rest of their accounts. This just stank of issues. Next up, solvency. The ability to fulfill long-term debt obligations, as we talked about. It's all about how much debt you have in your capital structure. Solvency ratios measure the relative amount of debt in capital structure, as we said. They're the debt ratios. The adequacy of earnings and cash flow to cover interest expense and charges relating from that debt. They are your coverage ratios. Now think about your debt ratios, how much debt we have. If those debt ratios are rising, we have more and more debt, we have more and more financial risk. As opposed to coverage, how much cash, how much earnings do you have available to cover your payments? The higher that is, the safer I feel. Because I've got earnings to cover my charges. So I start to get concerned when my coverage ratios fall. You would expect as debt ratios rise, coverage ratios fall. Now, once again, context is important here. Operating leverage may limit the company's ability to make use of financial leverage. We will talk about operating leverage in the world of corporate issues. Operating leverage, your fixed operating costs versus your variable. If you have a higher level of fixed operating costs, it introduces risk and it makes it more difficult to get financial leverage. So you'll compare that to your debt ratios, or rather use that as the context for assessing your debt ratios. Definitions. We said earlier on, there are no rules. For the purposes of this module, and they mention it in the module and say, look, different people use lots of different definitions. Clearly, as you have to do an objective test question in an exam, they want to be consistent. So for this module, for your calculations here, total debt is defined as the sum of interest-bearing, short-term and long-term debt. Things like accruals and accounts payable and leases, therefore, will not be classed as total debt. That doesn't mean that this module is right. It doesn't mean if you calculate it in practice differently, you are wrong. They just want a consistent approach, and this is the one they're using in here. So no, that's their definition of total debt. Coverage ratios, first of all, 2 to look at. Interest coverage, EBIT on the top. So your earnings before interest makes sense because we're looking to see if we can cover interest, and interest payments on the bottom. Often used in debt covenants. As we said, if it's high, we've got greater solvency. In practice, may be calculated differently. We talked a little bit about this in PPE. The problem with looking at your income statement, does it include in interest expense all of your interest paid? No, because some is capitalized. Hence, using interest payments here makes more sense. You're going to capture all your interest, but then you could question the wisdom of using an earnings figure. If you're obsessed about it being pure cash, surely on the top, you should be using a kind of CFO figure before interest. We use EBIT here. Fixed charge coverage makes an adjustment. It says, yes, there are interest payments, but I'm interested in leases as well. If you have leases, that is a fixed charge. That therefore presents just as much risk as interest. So I want to look at not just whether you can cover interest payments, but whether you can cover interest and lease payments, all of your fixed commitments. On the top, we'll again use EBIT here. You could argue you wanted to use cash flow. Definition here uses EBIT. But be fair, if we're including lease payments in the denominator, we have to add it back to EBIT on the top. We always need the figure on the top to be before we've made the payments. So EBIT is fine when it's just interest for interest coverage. But if we're adding lease payments to the bottom, we need our payments before lease payments, or rather earnings before lease payments on the top. Interest coverage, your absolutely basic debt covenant ratio that they look at. Fixed charge, if you've issued preferred stock, often used to measure the quality of the preferred dividend. The quality meaning the risk attached to it. Because this covers every single other fixed payment they're making. What have you got left? How safe, if you like, is that preference dividend? And on to leverage. You can see 4 main ones here. We've got debt to EBITDA at the bottom, which is kind of mixed, but our big leverage are debt to assets, sometimes known as total debt, debt to capital, debt to equity. And finally, financial leverage, which we'll talk about a little bit. These are pretty easy to remember. The clue really is in the name, and you find that for an awful lot of ratios. Debt to assets, total debt on the top, total assets on the bottom. Now, in terms of the rules in the module, we said you use average balance sheet figures when you have income statement to balance sheet. Well, here it's both balance sheet, both at a point in time. Therefore, we can use the most recent figures. No need to average. So total debt to total assets, obviously the percent of total assets financed with debt, the higher it is. The more leverage you have, the more financial risk you have. Or you can compare that same total debt to total debt plus total shareholders' equity, the percent of your total capital represented by debt. Or you can just do a straight ratio of that total debt to equity, shareholders' equity. All very similar. Quite often questions will just ask you, what is the impact on leverage? If they do, just use this one. It's the easiest for me. Now, I said we mention financial leverage. Why? Well, I just said if it's balance sheet to balance sheet, balance sheet to balance sheet, all the way down, then you use the most recent information. However, when we get to the financial leverage ratio, you can see they completely contradict what I just said and use average. Average total assets, average total equity. Why? Because we're going to see this ratio repeated in our DuPont analysis very shortly. And in there, they use average. They are just being consistent here and saying, look, given you're going to use average in DuPont, let's use average here. Bear in mind, year end is common in practice. I put a little DP here to say this is one of the ratios you're going to see used in DuPont analysis. And finally, debt to EBITDA, again, self-explanatory. Total debt, sometimes net debt. Some analysts will knock off cash and marketable securities compared to EBITDA. How many years would it take to repay your debt based on EBITDA? Again, here we're using the most recent debt figure. I know this is balance sheet income statement, but given my debt today, how long would it take me to pay it off given my EBITDA for the year? The higher that is, the longer it's going to take you to repay, the more risk there is. And our final category, profitability ratios. Some of these, if not all of them, you may have met before. It measures the return earned during a period, but as well as the margins, which we're going to be pretty happy with, I would imagine most of us, we'll also measure returns based on the amount of capital, the amount of resources we use to earn it. From our common size income statement on the left, we have our return on sales ratio. So what did we generate compared to revenue? So revenue in the denominator each time, we're just down the income statement, gross operating earnings before tax, net income. Net income over revenue, we will use in DuPont. What's the point of having all four? It just allows you to look deep into this net margin and say, where did it come from? How much was lost due to tax? How much was lost due to interest? Operating down to earnings before tax, we're deducting interest. How much was lost in operating expenses? Do I have an amazing gross profit margin and a terrible operating profit margin? That means you're losing control of operating expenses. Is operating profit margin great? But I get down to pre-tax and it's terrible. Then you've got a huge amount of interest. Look at your capital structure. So margin's great. It's all about how much profit does $1 of revenue turn into. On the right, not return on sales, but return on investment. How much did I generate using my resources, my capital, whether it's equity, assets, or capital employed? Few definitions again. First of all, operating ROA. ROA is return on assets. On the top, because it's operating income. On the bottom, average total assets. We're back here to income statement on the top, balance sheet on the bottom, so we're using average. We're using operating income because that is the return generated by our total assets. Total assets are funded by all providers of capital. So we want a return figure that's available to all providers of capital, i.e. before interest. ROA, a return on assets. Net income over average total assets. Difference between these two. Obviously, it's operating versus net income. This completely contradicts the argument I just went through. Total assets on the bottom is funded by all providers of capital. So I prefer on the top to have a return measure available to all providers of capital, operating income. ROA just takes net income. Bear that in mind. Return on invested capital, ROIC, if you will. Our invested capital, average total, short-term and long-term debt, and equity. On the top, EBIT into 1 minus T. So we're taking earnings before interest and taxing it. Because it's all providers of capital on the bottom, we want before interest on the top. I like that one better than the previous. It's more consistent. ROE is consistent. Only equity on the bottom. So net income, what's available to providers of equity on the top. If you have preferred shares outstanding, you might want to look at return on common equity. So get rid of the prefs, remove the preferred dividend from net income, and have only common equity on the bottom. And we're through the definitions. Bit of a slog, I know, but you have to see them all. The good news is we now start using them. Describe relationships among ratios and evaluate a company using ratio analysis. Nothing more to learn here, just analysis. Until we get to DuPont, which is kind of new, but it's just using ratios we already know about. But let's look at relationships. Here we go. A variety of ratios. An analyst is evaluating the liquidity of a Canadian manufacturing company and obtains the liquidity ratio shown in Exhibit 29. Time is going fiscal year 8, 9, 10, so time is going this way again. Current ratio 1.6, 1.9, 2.1. I would say, I don't want to go in red, sorry. I would say here liquidity is improving. Hooray. Quick ratio 1 to 0.9 to 0.8. Liquidity is not improving. Contradictory messages from the current and the quick. So let's think what's in both. The current ratio in the numerator, all of my current assets. In the quick ratio in the numerator, cash, short-term marketables, receivables. What's the difference? Inventory. If my current ratio is increasing and my quick ratio is not, I'm going to attribute that increase to an increase in inventory. That would force my current asset or other current ratio up, but not my quick. DOH. Let's see if that conclusion is backed up by days of inventory on hand. It is 30 to 45 and up to 55. Inventory is increasing. We are becoming less efficient at managing our inventory. DSO, 30, 28, 24. Okay, for DSO, the interpretation there is that I'm collecting cash quicker. So I'm managing to do a better job of turning my receivables into cash. Now, if I hadn't looked at anything else, I'd look at that and say, okay, well, that should be good news. But it's not really reflected in the quick ratio. If I was just turning a receivable into cash, so, let's say that was $300 receivable, and I just turned it into a $300 cash balance, that would not affect my current or quick ratios. Because remember, on the top, receivables and cash are in both. So it just doesn't matter to that ratio, whether it's cash, whether it's a receivable. It's still just part of current assets that they're measuring. So that can't be what's happening. To get a disparity between these two, this cash appears to be turning into inventory. You've got more and more and more inventory sat on the balance sheet. That is a big question. Why? What's happening? And we don't know. We don't get an answer. It's a good example of how to use ratios together to interpret what's going on in a business. This LOS is great. It just says you know lots of ratios, go and use them. Nothing new to learn in that LOS. Just combine them and beg questions. Let's do another. Anson and Clarence. Which way is time going? 2 to 5. So that way, that way. And we have an exam style question. Which of the following choices best represents or best describes rather reasonable conclusions an analyst might make about the company's efficiency? A, in financial year 5, Anson's DOH of only 4.76. Anson's DOH 4.76. Indicated that it was less efficient at inventory management than Clarence, who had a DOH of 39.73. There's Clarence. Well, lower DOH without any further information, you would assume means they're more efficient. So it's not a reasonable conclusion from that information alone to say it's less efficient. It's more. B, over the past 4 years, Anson has shown a greater improvement in efficiency than Clarence, as indicated by its total asset turnover ratio increasing from 0.84 to 0.11. Anson, total asset turnover, 0.84 to 1.1. Clarence, total asset turnover, 1.38, down to 1.06. I like B. If you are able to increase your total asset turnover, revenue over average assets, you are generating more dollars per dollar of assets used year on year. B is correct. It does, without any other information, suggest a greater improvement in efficiency. Let's check out C. In FY5, Clarence's receivables turnover of 8.35 times. 8.35. indicated that it was more efficient at receivables management than Anson, who had a receivables turnover of 10.75. Well, no, again, if you have a higher receivables turnover, you're turning over your receivables more quickly, which in turn will lead to a lower days of sale outstanding, more efficient. So Clarence is not more efficient. C is indeed incorrect. That's the LOS. We have ratios. Let's start using them. That leaves us with our final big task. We have a couple of LOSs at the end, which will take us about 9.5 seconds to get through. The last big one is DuPont. Demonstrate the application of DuPont analysis of return on equity and calculate and interpret effects of changes in its components. All we're going to do here is break down a ratio we've already met, ROE. And here it is. DuPont analysis. Used first by the DuPont Corporation. We have ROE, return on equity, being net income divided by average equity. This we already know. We've already met ROE. It is a profitability measure. What is the net income you generated given your average equity for the year? And on a very high level, we can say higher ROE is good. We like it if ROE has increased. But what we'd like even more is to find out why. What's driving ROE? How did we manage to get it to increase? That's what DuPont will do. We are going to decompose ROE into its components. And we're going to do it in 3 stages. First of all, we'll take ROE and we'll say, yep, we know it's net income over average shareholders' equity. But we can decompose that and say that is equal to net income. Okay, there's net income over average shareholders' equity. But we can break it into 2 ratios. Net income divided by average total assets and average total assets divided by average shareholders' equity. Mathematically, these 2 cancel out and you are left with ROE. The great news about doing it this way, we are breaking down ROE into 2 ratios we already know. Net income over average total assets is return on assets. Average total assets over average shareholders' equity, you said we're going to use that, is leverage. So sit back and look at that. You as an analyst can say, we can improve our ROE either by improving our return on assets, generating more net income per dollar of assets used, or we can improve ROE by using leverage, assets to equity. What's the difference between total assets and equity? Liabilities. The more of your assets you fund with liabilities, the smaller the amount of equity you use, and hence the higher your ROE. If I can generate all of my net income using debt, ROE will be huge. So either we can get a better ROA, or we can get ROE looking better by using leverage. What's Anson been up to? ROE. Here is what we're trying to analyze. From years 2 to 5, it's going this way. We're minus 0.62 up to 1.62, 1.6. Oh, it's going gangbusters. Massive improvement in ROE. From negative 0.62% to 5.92. I want to know why. What is driving that? So, sketching out over here, let's break it down into ROA and leverage. Here's my return on assets. Where's my leverage? Right down at the bottom here. So take 3.7 multiplied by 1.6 gets you ROE. And you can do that for each and every year. Now, you don't need to do the calculation because they're not going to give you deliberately incorrect figures. You just need to look at the trends. Obviously, ROE has gone through the roof. We want to know why. Is it due to leverage? Have they simply started using more leverage to get a better ROE? 1.6, 1.54, 1.58. No, that's pretty indescript, isn't it? That's pretty constant. It's not absolutely constant, but, it's constant-ish. So it must be ROA. Yep, minus 0.39, 15,1537. To answer this question, for Anson here, what is driving ROE? ROA. They are managing to generate more net income per dollar of assets in fiscal year 5 than they were in 2. It's not leverage, it's ROA. But how did they manage that? If it's not leverage and it's ROA, was it because they suddenly started generating a lot more net income with their given asset base? Or was it that they have the same net income, but they've managed to bring their asset base down? Well, let's read on and find out, because we can break it down even further. Here's ROE again. Net income over average shareholders' equity. We're still going to end up here with net income over average shareholders' equity, but we're doing, and what's now known as the basic DuPont, we're now breaking it down into 3. We're now doing a longer decomposition. Our first ratio will take net income and divide it by revenue, and then we'll put revenue up here, so they're going to cancel out. We'll divide revenue by average total assets. We'll put average total assets up here, so they cancel out. Mathematically, we've still got net income over equity, but what have we done? We've still left leverage in there. Our final ratio is still leverage. But we've broken ROA down into net income over revenue, our net margin, and revenue over total assets, total asset turnover. Leverage is leverage. Net margin, how many dollars of profit do you make per dollar of sales? Some people will call that the quality of your sales. Do they translate to profit? Total asset turnover. That is how many dollars, I don't want to write 1 there, sorry. How many dollars of sales per dollar of assets? That some people think of as quantity. Total asset turnover is telling you how much revenue do you generate with your asset base. Net margin is saying, given that revenue, how much of it turns into profit. Quality and quantity. You can have 2 completely different businesses. So let's ignore leverage for the minute. Let's say we've got 2 businesses with the same leverage. You can have 2 completely different business models to get back to the same ROE. Grocery stores, again, is an example I like to use. I'm not going to quote any because I don't want to offend people as to where they buy their groceries. But I have ones in mind. I'm sure you can picture them. There are grocery stores in the middle of desirable locations in the cities, which have beautiful fixtures and fittings, calming music, 18 staff per customer, hand-washed vegetables, and so on. And they're just a beautiful experience. There are no lines at checkout, etc. You feel good about what you're buying. And you pay for it. You pay an enormous amount. So they make a huge margin. The downside, to get those stores kitted out as they do, takes a huge amount of assets. So they can achieve an ROE with a big margin, but they're not going to have such a great total asset turnover. As opposed to the kind of store that's on the edge of town, bit of a drive to get to it. It's in an abandoned mall. When they go in, they give you a headlamp and say, its stuff is in boxes out the back. If you can find it, bring it back here. We'll ring it up. And there are 3,000 people in line before, and so on. You get the idea. They have virtually no assets. They have a big shed in the middle of nowhere. They can achieve a really impressive total asset turnover. They pile it high and they sell it cheap. So yep, the asset turnover is great. The margin is terrible. But those 2 business models could get back to the same ROE. That's what we're trying to do with DuPont. Where's it coming from? Or, as we're doing here, rather than cross-sectional, over time. Once again, Anson. Once again, we've got this impressive growth in ROE. We're trying to break down where did it come from. This time, we are going to take net margin, total asset turnover, and leverage. Now, leverage, we've already ruled out from the basic breakdown we did on the last slide. So it's not leverage. But let's look between net margin and total asset turnover. Well, it's both. We've turned a negative net margin into a positive and improved total asset turnover. That is a win-win. We're generating more revenue per dollar of assets, and from every one of those dollars, we're turning more of it into profit. Good news. But how are we doing that? Because you can see total asset turnover, yes, kind of went up, but it wasn't as spectacular as this. My net margin minus 0.47 up to 3.33 is spectacular. I'd like to know how we did that. Let's find out. But before we do, just to leave you hanging for a moment, let's just do a quick example to make sure we understand what's happened so far. We've got Anson compared to Clarence. Anson and Clarence in Exhibit 40 example, which is what we did earlier. Which of the following choices best describes reasonable conclusions an analyst might make about the company's ROE? A. Anson's inventory turnover of 76.69 indicates it's more profitable than Clarence. Nope. That's efficiency. It's not part of the breakdown of ROE. B. The main driver of Clarence's superior ROE in financial year 5. Clarence, financial year 5, ROE 9.28 as opposed to 5.92. Is its more efficient use of assets. More efficient use of assets. That's total asset turnover. My basic DuPont here that I was looking at, margin times asset turnover times leverage. The efficient use of assets is that middle one, asset turnover. Let's take a look. Total asset turnover for Anson, 1.11. For Clarence, 1.06. The main driver of Clarence's superior is more efficient. No, it's lower. That's wrong. Total asset turnover is lower. That is not a more efficient use of assets. C, the main driver of Clarence's superior ROE in financial year 5, greater use of debt financing and higher net profit margin. So, both of these, let's have a look. Leverage of 2 as opposed to 1.6, yes. Higher leverage, greater use of debt. Higher net profit margin, 4.38, 3.33, yes. Higher margin, it is C. So, quick example we sneaked in there before. I kind of left you hanging on how we're going to break down the margin. So let's get back to that. It's our final decomposition. We have leverage. We're not touching that. We have total asset turnover. We are not touching that. All we're going to do is take net income over revenue and break that down into 3. So bear that in mind. A lot of people say, I get the basic DuPont. I've struggled to remember every format. Remember, all you're doing is expanding what we've already got. If you know the basic DuPont of net margin, total asset turnover, leverage, all we're doing when we go for the extended version is splitting that net margin into 3. How do we do it? Pure math once again. We are starting off with net income over revenue. Net income over revenue. But we'll take net income over EBT and then put EBT up here so they cancel out. We'll take EBT over EBIT, put EBIT over here so they cancel out. These two cancel out. These two cancel out. You are left with net income over revenue. It's that simple. Now let me just, so you can still see it, get rid of those. I've done a little example here because people tend to hate this, just to show you how utterly simple this is. Now, why I remember it, no mnemonics, anything like that. You are starting with net income and you are ending with revenue. So you've got to back yourself to remember that. You know the basic DuPont had 3. This is easy to remember. You're breaking your net margin into 3 as well. And it's net income over revenue. Only 2 other things to remember. And it's easy. You start at the bottom of the income statement with net income, the number you're looking for, here. And all you do is start to work your way up the income statement, one expense at a time. So you're at net income. If you start to try and work your way up the balance sheet from net income, what's the first expense you hit, i.e. the last one on the income statement? It's tax. So you jump over tax and you get to earnings before tax. Net income divided by earnings before tax. Obviously, the difference between the two is tax. That ratio is known as the tax burden. Once you're there, you keep going. If I'm at earnings before tax and I want to keep going up the income statement, what's next? Well, if you're at earnings before tax, next thing up you'll see is interest. So you jump over interest. So you have EBT over EBIT. Because the only difference between them is interest, it's known as the interest burden. And then there's only one more, and you've got to get back to revenue. So you're at EBIT, you know you divide that by revenue. Final expense you jump over is operating expenses. That's it. You're just working your way up the income statement. To prove it works, net margin here is 315 over 1,000, 31.5%. All right, let's work our way up. Let's jump over the tax to get back to 450. That will give you 315 over 450. The difference between the two is tax. That is 70%. It's known as the tax burden. Quick way to calculate it, look at this. I set this up so tax is at 30%. Your tax burden is 1 minus T. Let's keep going. I've got up to 450. I know it needs to cancel out, so it has to go there. Keep going, jump over interest, you'll get to 600. 450 over 600. That is my interest burden. The only difference is interest. 75%. How'd you calculate that? Well, it's not quite as interesting, no pun intended, but you could calculate an effective interest rate here, 150 over 600, and your interest burden would be 1 minus that effective interest rate, if that gets you excited. 600 is here, so put 600 here. 60% is your EBIT margin. 0.7 times 0.75 times 0.6 is 31.5%. And you're done. That is the majesty of DuPont analysis. Yes, you need to remember the terms, but more importantly than that, know the names of the ratios, how we break it down, and how each impacts ROE. The great news is, because they're all just multiplied together, an increase in any of these will increase ROE. Questions are much, much more likely to focus on the interpretation than the calculation. Why? Well, imagine a question said, using extended DuPont, so this full 5 ratio hit, using extended DuPont, calculate ROE. Well, to give you the tax burden, they would have to give you net income. To give you leverage, they would have to give you average shareholders' equity, so the smart money is on just calculating ROE directly. That's why questions tend to instead focus on the interpretation. Let's see that. The kind of open-ended question here, what might the analyst conclude? And when I say open-ended, they really do go nuts with the answer here, but more on that in a moment. An analyst examining Amsterdam PLC, a hypothetical company. Now, context. I have none. It is Amsterdam PLC, a hypothetical company. I've got absolutely no idea what they do. So we'll do what we can, but it's not going to be very interesting. Wishes to understand the factors driving the trend in ROE over a 4-year period. I see what they're doing. They're not really bothered about outside macro factors here. What they're concerned with is what happened to ROE and use DuPont to see what drove it. Obtains and calculates the following data from the annual reports. So this is what we're looking at, ROE. 14 to 17, time is going this way. So ROE, 24, 26. Ooh, a little dip there. And whoa, plunge. ROE has been driven downwards. Why? Well, helpfully, we've got tax burden times interest burden times EBIT margin. Those three together gave you your net margin. Multiply by asset turnover and leverage. Let's start from the bottom. 2.14, 2.1, 2.17, 2.15. Leverage is not interesting. Asset turnover, 144, 147, 171, plunge. So in 2017, certainly one of the factors, a reasonable conclusion would be the asset turnover contributed to the drop. Net margins, tax burden, 58, 63, 52, 60, all over the place. I can't really see too much excitement there. Interest burden, 97.49, 86, 73.49. We're back where we started. Nothing really interesting there either. EBIT margin, 13.98, 13.98, 11.7. EBIT margin. The two things that jump out at me in 2017. I think the analyst will conclude that ROE fell due to EBIT margin and asset turnover coming down. What does that mean? We're being less efficient, and our sales are being less profitable, if that's indeed a phrase I've just made up. You're generating less profit, or certainly EBIT, per dollar of sales. It's nothing to do with tax or interest, and that's kind of backed up by the fact that leverage didn't change that much. So it's your operating margin, your EBIT margin, and your asset turnover. That's what I would conclude. Now, I said they went mad in the answer. In the answer, they attribute this to oil prices. If you can work out why, then let me know. But we have no idea what Amsterdam PLC is doing. Its entire business might be to short oil. So in which case, oil prices were next. So I don't know why they did that. This really is all you conclude. We have no other context. And we're done. I mean, you can quite clearly see, because there's time left in the video and an LOS on the screen, that we're not done. But in terms of what we need to learn and apply, our work is finished. A couple of LOSs to finish off. First of all, describe the uses of industry-specific ratios used in financial analysis. There's one paragraph in the module. That's it. So be aware there are industry-specific ratios. What I'm going to do is just bring up one from earlier, and this is basically what the LOS needs you to know. But I'm bringing up one of the very early examples because I think it's a good example of this. It says, a US insurance company reports its combined ratio. So you scan through your head. Did we see that in activity? No. Did we see it in solvency? No. Liquidity? No. Profitability? No, we did not. We've never met it. It is an industry-specific ratio. It's used in insurance. It's determined by dividing losses and expenses. Expenses incurred, dividing that by net premiums earned. Okay. I've been given an industry-specific ratio. I'm not going to cry about the fact it's not in the curriculum because they gave me the definition. Now I know exactly what it is. The LOSs say interpret ratios. If you've been given what the ratio is, you should be able to interpret it. Losses divided by premiums. If I want to put a positive spin on this, if I want to conclude good things are happening, what do I want to see happening? It would be great if premiums earned were high and losses were low. So for this ratio, lower is better. That's what I would conclude. What's happening here? Time is going 1 to 5, 101. Well, look at this. Here and here, and here to that matter. In those three, losses and expenses were greater than your premium earned. That's not great. You know, I'd say this was an industry-specific profitability ratio, and here you're incurring more expenses than you're earning in premiums. Look better in fiscal year 3, and it's come way down in fiscal year 5, 90.1. All right. So all I could really say is, yeah, that's an industry-specific one. I'm not going to calculate that for a manufacturer. I mean, it makes no sense. It literally makes no sense. They don't earn premiums. I can say here as an analyst, the fact that it's come down to 90 is good, but what's my benchmark? What does the industry expect? I don't know. Is 90 good? Is this disastrous? Were they on the brink of failure if it goes above 100? Should it be closer to 80? I just don't know. You'd need to know macroeconomic conditions. Now, were these conditions terrible for insurance companies and so on? So I can conclude that lower is better. It's an industry-specific ratio that I can very easily kind of interpret in that sense. But beyond that, I'd need a lot more information. Now, that's just one example. There are an infinite number of examples. I mentioned earlier on in retail, you would use sales per square foot. Not going to use that in the insurance industry and so on. And finally, just as quick, describe how ratio analysis and other techniques can be used to model and forecast earnings. Well, you've got an entire reading on modeling, a practical element to modeling. And in terms of forecasting, we'll talk about it in equity. So there's nothing really new in here at all. We just need to mention a couple of definitions. Based on forecasts of growth and expected relationships among financial data, analysts can build models. Your classic, let's take sales. Once we have sales, we'll use our expected relationships, our ratios. If I know what my typical operating margin is and I can forecast sales, I can forecast my operating profit. Given sales, I know what percentage of sales receivables is. I can start to build the balance sheet. How might I do that? Start to use days of sales outstanding and so on. And that will get you to a forecast. But be aware, and that's really all that we need from this reading is a few definitions. Just be aware that you should not be concluding, this is my forecast and I'm sticking to it. Profit in 5 years' time will be 9.84623 million. You have to be aware of the inherent limitations in forecasting, the uncertainty. And you can do that using sensitivity, scenario analysis, and simulation. Sensitivity, what if analysis is a term they give it in the module. A range of possibilities as specific assumptions are changed. So you change one assumption. Maybe you change the assumption that sales is going to grow by 10%. You instead grow it by 8%. What does that do to your output? As opposed to a scenario analysis where you're changing everything. Let's change economic events, the background. And if you have mutually exclusive and exhaustive events, you can give probabilities to them and calculate the mean or median output. For example, you might just say, look, the economy is either going to boom, be average, or be in a recession. 30% chance of this, 40% chance of this, 30% chance of this. Calculate my forecast for each. I can work out mean, median, etc. And a simulation, computer-generated sensitivity or scenario analysis based on probability models for input factors. For example, as you've seen elsewhere in the curriculum, a Monte Carlo simulation. You can run thousands and thousands and thousands of iterations of what you think might happen. The software will keep picking out, based on probability models for the inputs, picking out those variables, combining them together to get your forecast. Literally here, we just need to know those definitions. And that's it. Long reading, we had to introduce all of the ratios and how they're calculated. As I keep saying, focus on the analysis.